Most people in crypto think risk looks like a crash. Red candles, charts bleeding, prices falling fast. But the most dangerous risk in crypto doesn't look scary at all. It looks quiet, normal, almost boring. And that's exactly why it destroys so many investors. If you're in crypto right now, stop scrolling for a second and listen carefully, because this is something almost nobody explains clearly. Before we go deeper, if you want real crypto content without hype, without fake promises, and without influencer nonsense, subscribe to the channel now. It helps more than you think. This content is for informational purposes only and does not constitute financial or legal advice. Here's the truth. Most people don't lose money because they pick the wrong coin. They lose money because they misunderstand time. Crypto doesn't just punish bad decisions, it punishes bad timing. And timing isn't about buying the bottom or selling the top. That's Hollywood crypto. Timing is about how long you're exposed to risk without realizing it. Let me explain. In traditional markets, risk is slow. In crypto, risk is compressed. Weeks of damage can happen in hours. Months of mistakes can show up overnight. And the scariest part? You usually don't feel anything while it's happening. You feel safe until you're not. A perfect example is leverage, even when you're not trading. Many people say, "I'm not using leverage, I'm safe." But leverage exists everywhere in crypto, even if you didn't click a leverage button. Liquidity pools, yield platforms, lending protocols, even simple staking. You're often exposed to other people's leverage without knowing it. So when something breaks, it doesn't break slowly, it snaps. Another silent risk is over-optimization. Everyone wants to be efficient. Higher yield, lower fees, faster returns. So they move funds constantly, chain to chain, protocol to protocol. But every move adds risk. Smart contract risk, bridge risk, human error. Ironically, trying to be smarter often makes people more fragile. Crypto rewards simplicity far more than people think. And then there's information risk. This one is brutal. Crypto moves on narratives, not facts. By the time something is confirmed, the market has already reacted. Most people don't realize they're always late. Not because they're dumb, but because the system is designed that way. Whales move first, insiders whisper second, social media explodes third, retail reacts last. If your strategy depends on speed, you're already in trouble. At this point, if this is making you rethink how you approach crypto, drop a comment. I read them all, and it helps push this content to people who actually need it. Now let's talk about the most uncomfortable part, confidence. Crypto doesn't reward confidence. It punishes it. The moment you feel sure, you stop managing risk. You increase size. You relax rules. You ignore warning signs. Confidence slowly turns into exposure. And exposure is what wipes people out. The best crypto investors aren't the smartest. They're the most paranoid. They assume something will break. They assume platforms can fail. They assume liquidity can disappear. So they plan for exits before they enter. If you don't know exactly how you would exit a position in a bad scenario, you don't have a strategy, you have a hope. And hope is expensive in crypto. Here's the key idea I want you to remember from this first part. The biggest crypto risk isn't volatility. It's staying exposed longer than you should because nothing seems wrong. If you're still here, you're already ahead of most people. Make sure you're subscribed because this topic goes much deeper, and the second part will change the way you look at crypto forever. Most people think surviving crypto is about being right. Right coin, right narrative, right timing. But long-term survivors play a completely different game. They don't try to predict what will happen next. They prepare for what could happen next. And that shift alone changes everything. Let's talk about exposure, because this is where most portfolios quietly die. Exposure is not just how much money you invest. It's how many things need to go right for you not to lose money. If your position only works if the market goes up, liquidity stays high, the protocol stays solvent, the bridge stays secure, and sentiment stays positive, you're overexposed, even if the position looks safe. Real risk management is reducing the number of assumptions you're making. The fewer assumptions, the stronger the position. Another mistake almost nobody talks about is emotional latency. Crypto moves fast, human emotions don't. By the time fear hits, price has already moved. By the time greed hits, opportunity is already priced in. So if your strategy depends on how you feel in the moment, you're always reacting to the past. That's why rules matter more than intelligence. Rules don't panic. Rules don't get bored. Rules don't revenge trade. If you don't have rules written down, your emotions are running your portfolio, even if you think they're not. And here's something uncomfortable. Most people don't want freedom from crypto risk. They want excitement. Flat periods feel boring. Small gains feel pointless. Slow growth feels like failure. So they increase risk just to feel something. Crypto is one of the only markets where boredom is actually a good sign. Bored usually means you're not over-leveraged. Bored means nothing urgent needs fixing. Bored means you're probably doing fine. Now let's talk about liquidity illusions. In bull markets, everything feels liquid. You can enter easily. You can exit easily. Until you can't. Liquidity disappears before price collapses, not after. When everyone wants out, there are no bids waiting for you. That's why position size matters more than conviction. You should always be able to exit without moving the market against yourself. If you can't, your position is too big, no matter how good the idea sounds. At this point, if this video is forcing you to rethink how you manage your crypto positions, hit the like button and leave a comment. It tells the algorithm this isn't just noise. Another silent killer is complexity addiction. People love complex strategies because they feel sophisticated. Multiple wallets, multiple chains, multiple protocols. But complexity increases failure points. The best strategies often look boring on the surface. Few assets, clear rules, simple execution. In crypto, elegance beats complexity every time. And finally, let's talk about survival, because that's the real game. Crypto rewards those who stay in the market long enough to catch big cycles. You don't need to catch every pump. You don't need to trade every day. You don't need to be early on everything. You just need to not get wiped out. One bad decision can erase years of progress. So protecting downside is more important than chasing upside. If you remember nothing else from this video, remember this. Your goal in crypto isn't to be right, it's to still be here. If this kind of content helps you think clearer and invest smarter, subscribe to the channel and share your thoughts in the comments. This community grows by people who actually care about understanding risk, not gambling on it. This content is for informational purposes only and does not constitute financial or legal advice. We'll keep breaking down crypto the way it's actually experienced, not the way it's sold.